Are you an NRI trying to understand the Indian financial market? Are you confused about the risks associated with it? If yes, this video will help you understand the common risks. In the end, there's a bonus section as well where I will discuss how you can avoid making common mistakes while investing in India. Imagine a bustling nation of 1.4 billion people surpassing China. It might sound surprising, even a bit shocking, right? But within this crowd lies something truly remarkable. An immense potential for business to thrive. The Indian market isn't just a static, it's a vibrant ecosystem where entrepreneurs dream big, investors find potential, and innovation knows no bounds. Now let me take you on a journey to uncover how this diverse, dynamic market is not just shaping lives but also fueling the 2023 economy. Let's discuss some key factors that have helped the Indian economy over the last 5 years. GST and the Insolvency and Bankruptcy Code (IBC). These two policies have improved the ease of doing business in India. I promise this won't be another IG reel about how to save on GST. I'm sure you've watched many of them. Long story short, GST is a comprehensive indirect tax that replaced multiple existing taxes like service tax, excise duty, sales tax. The new GST regime launched on 1st July 2017 completed 6 years. During this time, it's played a significant role in formalizing the economy and increasing government revenue. GST revenue climbed from 8.76 trillion rupees in 2018-19 to a whopping 13.25 trillion in 22-23. IBC also had a major impact in addressing the problem of non-performing assets. The IBC focuses on maximizing asset value. By 31st March 2022, NPAs were at 7.6%, a record-breaking low in 6 years. That's not all. IBC opened the doors, allowing investors from around the globe. This act drew interest from many who wished to buy the struggling companies and making them successful again. IBC has not only given a fresh start to financially distressed companies, but it has also infused new capital into the economy. What a blockbuster comeback story, isn't it? Then you have the growth of the IT sector. You can compare India with that backbencher kid in your class whose grades suddenly challenged the toppers. In 2014, India was the 10th largest economy in the world. Fast forward to today, India has maintained its position as the fastest growing major economy for 3 consecutive years. In 2023, India's tech sector is expected to exceed $245 billion mark, marking an exceptional increase of $19 billion higher from last year. The nation is gearing up for incredible growth, fueled by its dynamic technology industry, among other contributing factors. Domestic consumption is a major driver of the Indian economy. The growth of the Indian middle class has led to increased domestic consumption, which has then boosted the Indian economy overall. Even Finance Secretary T.V. Somanathan is optimistic about India's domestic growth, projecting the rate at around 6%. Looks like it is indeed time for India's growth. Now that we know the factors driving the Indian market, let's look at different types of financial markets in India. Like any other market, the Indian financial market bridges the gap between buying and selling, so that borrowers who need funds can easily get them from the lenders. The financial market is divided into various types. India's per capita income has increased 175% in the last 10 years. Even Finance Minister Nirmala Sitharaman tweeted that India is now the 5th largest economy in the world. No wonder NRIs are so keen to invest in India. There's been a significant flow of investments by NRIs due to multiple investment options here. Mutual funds, stocks, IPOs, and even bonds. A recent survey by SBNRI showed that 53% of NRIs said that investments in India offered higher returns. I assume you've already started daydreaming about investing in India. But wait, before you start, there are some common risks as well that you need to know about when investing. Investing is like driving a car. Every time you're on the road, there's a fair chance of encountering unexpected road bumps or situations, a wrong turn, heavy traffic, muddy roads, or potholes. These uncertainties make driving a bit risky. Similarly, in investments, there are unforeseeable events such as economic downturns, market volatility, or unexpected company performances. Now, these uncertainties can impact your investments. Just like you cannot control what happens on the road, investors cannot control market uncertainties. Risk is the uncertainty of whether your driving will be smooth or face challenges due to factors which are beyond your control. In short, risk in an investment shows whether the change results in a potential for gain or a possibility for loss. But if you are aware of these uncertainties, it will help you make wise investment decisions and plan for potential setbacks. Financial assets are affected by two risk categories. Systemic risk. In systemic risks, a large percentage of the economic market gets affected. This means you cannot diversify your portfolio as the probability of loss is caused by macroeconomic factors like natural disasters, political instability, exchange rate, etc. Now you know why systematic risks are also known as market or undiversifiable risks. Do you remember the Great Recession in 2008 and how it wiped off over $2 trillion from the global economy? Nobody would have thought that an event at a company level could trigger instability or a collapse at such a widespread level. This is a classic example of systematic risk, as it shows how risks in one sector could lead to the downfall of the entire market. Factors like toxic assets or subprime housing market issues were some of the reasons leading up to this recession. Investments that are nearly impossible to sell are called toxic assets. Now that you have a fair understanding of what systematic risk is and what it does, let's move on to the types of systematic risks. Next, you have unsystematic risk. It's known as specific risk, diversifiable risk, or residual risk. A type of risk where the probability of loss is within a specific industry. To understand this, we have to go back to the 2015 Volkswagen emissions scandal. Volkswagen was caught cheating on emission tests for their diesel vehicles. This caused a recall of millions of vehicles and billions of dollars in losses. This shows how a company's specific risk can have a significant impact on investors. Due to the emission scandal, investors in the company were exposed to significant losses. However, investors who diversified their portfolios across different industries faced reduced risks. Unsystematic risks have also got different types. Investing in any market involves risk, and the Indian market is no exception. And you might want to listen to why investing in the Indian market could also be risky. Exchange rate fluctuations between the Indian rupee and other major currencies can impact the value of investments, especially for NRIs. A change in interest rate by the RBI can influence borrowing costs and consumer spending, which affects various sectors in the market. Some companies in the Indian market may also face corporate governance issues and challenges which could affect investor confidence. Instances of fraud, mismanagement, or insider trading can impact stock prices. NRI investors must be careful who to invest with and always choose to invest with a reputable broker. Doesn't it make you stay away from investing? Maybe you want to hear what ace investor Warren Buffett has to say. Warren Buffett had two rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. But how do you not lose money? Let's talk about some mistakes you can avoid while investing. Fear of missing out, or FOMO. Imagine your friends are investing in a new stock. They're all talking about it all the time. Suddenly, even your neighbors start talking about the high returns they've got. Fearing you might miss out on these big profits, you invest without proper research. You invest half of your savings. Later, the market crashes and you end up losing this money. This scenario explains how FOMO-driven decisions can lead to financial losses. As an investor, you must avoid decisions solely based on the fear of missing out. Instead, focus on research and a well-planned investing strategy. Emotions play a crucial role in the world of investment. Let's say you invest in a stock for the love of the company's products and values. You are content with your decision and are even planning to hold it for the long haul. However, one day the stock price dropped due to negative economic news. You fear loss and make an emotional decision to sell all your shares. A few days later, the market stabilized and the stock you sold began to recover. If only you had made the decision based on the company's strong fundamentals instead of your emotions, you would have seen the value of your investment bounce back. Now, this scenario explains how most people tend to make rash, emotional decisions while investing. So to be successful in your investing journey, make decisions based on careful analysis and long-term goals. You must have heard the phrase, ignorance is bliss. But in the case of investing, ignoring the basics is not. A friend tells you about a new online trading platform that promises extraordinary results. Intrigued by quick profits, you ignored the basics of investing. Researching the platform's credibility, understanding the investment products, and analyzing the associated risks. Assuming everything will work out as promised, you get the shock of your life when you find out that it is a scam. When you start investing without basic knowledge, it leads to poor investment choices and missed growth opportunities. Everyone in the investment world must have heard of predicting the market movements. Picture a scenario where you read a news article predicting a downward market movement, perhaps due to a geopolitical issue. Now, this is where emotions and FOMO override. You plan to sell the stocks and expect to buy them back when the market dips. However, the prediction does not happen and the market surges. Now, the stock prices you sell have risen, which forces you to buy the same stocks at a higher price. The attempt to time travel has backfired. Trying to outsmart market fluctuations might result in missed opportunities, increased costs, and even a loss. It's quite natural to assume that what worked in the past will continue to do so in the future. Let's say you invest in a particular stock as they've shown exceptional growth, outperforming some major tech leaders in the market as well. So, you decide to invest. However, the following year, the technology sector faces challenges, leading to the downfall of stock prices. Now, you suffer high losses because you chased the past performance while ignoring the market dynamics. This scenario is a good example of ignoring market conditions or long-term viability of your investment. You frequently buy and sell stocks, thinking more activity means more profit, buying and selling various stocks so that you can profit from minor price fluctuations. Everything is good at the beginning as you start making these small gains. However, excessive trading leads to high transaction costs and capital gains taxes, reducing your overall returns. Overtrading often decreases portfolio value, and I've already discussed the decisions we make during emotional stress, right? So let's pledge today to focus on a well-researched, disciplined approach rather than following the temptation of frequent trading. What happens when you put all your eggs in one basket and the basket falls? All of them break. Now imagine this from the point of view of an investor. You invest your entire savings in one company's stock believing in the growth potential. You did not diversify. What will happen when challenges like regulatory changes or management risk impact the company? Your lack of diversification means there is nothing to balance your lost investments. 2024 is less than 2 months away, guys. I'm sure you're ready with the list of your new year goals. Add a new column to that list. Actionable plan to achieve this goal. Because be it your financial goals or other new year goals, it's difficult to achieve them without proper planning. A well-structured plan is your guiding star, helping you navigate the investment universe with purpose and with direction. On the other hand, lack of planning will lead to inconsistent investments and returns. Without a clear roadmap, you struggle to weather market volatility and potentially can miss out on growth opportunities as well. An ideal investment plan must include in-depth market research, clear investment goals, and diversification across different assets to reduce risks. Additionally, it must align with your financial goals and have the room to adapt in response to market dynamics. Before you go and plan your New Year's investments, let's revise what we learned in this video. We discussed how India became one of the fastest growing economies in the world and why NRIs are optimistic on India. Nonetheless, while investing in India, we must always educate ourselves, have an investment plan in place, and diversify our portfolio. Keep FOMO and emotions aside while making investment decisions. That's all in this video, guys. If you found it useful and helpful, don't forget to hit like and subscribe to Groww NRI. I will see you soon in the next video. Until then, keep growing.